All right. So anytime that you have price go up, the key is in trading. If you're looking to be bullish for price, you obviously think price is going to go up. What's key in trading and is the definition of good location is how quick the trade and price goes your way, how quick the trade becomes profitable. It'll help you managing your risk on trades because you know that in a certain amount of time it should start working. So when you get into a zone and your locations are good, it tells you if it's not working, a good opportunity to get out. One of the things that we look at when we tag longs and shorts, and I want you to look right in here, it's a bunch of longs that came in. Generally, that means, hey, too much competition, we're not going to go up. And it is true. That's what it means. But watch it go away. When it goes away, it almost gives price permission to go up. And I want you to think of it from your vantage point. When you're long, thinking price is going to go up, and then you scratch it or take a -1 or a +1, small winner, small loser. You thought it was going to go way up to here. You get long in here, and then you scratch it, and then you see it go a little bit. I bet you're anxious. I bet you're inclined to reach. And that becomes the self fulfilling prophecy of why price goes up with a probability when a bunch of people get long and then get out right where they got long. And we see this often. So it's not just more shorts, it's also less longs that happen. And what's important is this equation. For price of anything to go up, you need a combination of more buyers and less sellers. Less sellers, more buyers. You have to get that combination. And the price of any product or good goes up. What's key though is how do you get there? How do you get to that combination? If we all agree you need more buyers and less sellers for the price of anything to go up, how do you get there? One of the ways is to have longs that create more selling above go away. Less longs, less sellers. After they file down their long, they get out of it. They're no longer trying to sell it above. So you kind of get to the less seller side of the equation. And that's what's important. And that's what we see a lot when the longs come in and go away. Everything has to be explained into a dynamic that you could connect with immediately to your own emotional experiences. It's the only way you're going to be able to turn learning into understanding is when you could connect to it with your own personal emotional experiences. And I ask people always default back to how they feel when they're long and the certain feelings you get when you get out too soon, you hold on too long, and anything else in between. When you're short, when you're long, when you're right, when you're wrong, because that's how the market feels, and that's where the reads come from. The good reads come from reading other people in a group when they're pissed, when they're not, when they're too long, when they're too long, and then taking out, giving us the best chance to do what? To pop like that. So let's show it again. Longs come in. Let's clear some of that. Longs come in right there. They go bye bye. We rally. And then they come in and stick right in there. And that was the curl back over. And we've seen that on certain rallies throughout the session.